I've written for CoinDesk, Forbes, and Bitcoin Magazine, and hopefully some other publications as well, independent journalist. And today we get to talk about Placeholder and interview Chris Burniski and Joel Monegeo, who are partners at Placeholder. So, I guess my first question is an introduction question. Do you want to tell us a little bit about Placeholder and how you guys got started? And
sure.
Chris Burniski, Joel Monegeo.
So I guess the first thing to note is that, well, if I take a step back, when Joel and I met in early 2016, the conversation around crypto assets and tokens was not what it was, but Joel was focusing on the crypto space, even though it wasn't called the crypto space at the time.
Called it blockchain.
Just blockchain.
It's called blockchain.
That was in the midst of the first blockchain, not Bitcoin frenzy, which I think we're weirdly enough kind of coming back to again right now. But Joel was covering the space from the venture capital perspective. I was covering the space from the public markets perspective. And crypto is kind of the intersection of the two, starting with teams that are just getting off the ground, that have a liquidity event of some sort, be it an airdrop or starting to mine, or be it an ICO, and then transition into public markets asset. And so that sits at the intersection of our skill sets. And we decided to raise a venture firm or a venture capital fund. And what that means is it's committed capital that we call over time, over a 4-year investment period. And we did this, or we chose this structure as opposed to a hedge fund structure because it really insulates us from the volatility of the markets and allows us to build big positions that we hold for the long term and really go to work for our portfolio networks. And Decred is one of those portfolio networks, and actually the biggest position in our fund at the moment.
Can you tell us how much you have in your fund?
Go ahead.
So the fund is $150 million. It's a 10-year fund, and so our investors are locked into the fund for 10 years, and we make all investment decisions and distribution decisions. Right. But the key thing is that we deploy that capital over time. In a hedge fund structure, the fund managers receive the capital up front, and then they allocate it immediately. We felt that we were in an early stage enough part of the development of the ecosystem that we decided to go for a structure that gives us a little bit more longevity.
Can you just tell me, $150 million, how does that compare to, and there's a lot of investors and hedge funds in the space, a lot. How does that compare with other,
Well, what did Polychain first open with?
I mean,
Joel led the Polychain at USV.
He did.
So that's one of the nuances, is that a hedge fund is more open, and so a hedge fund is able to raise more money over time. We do a single close. So it's hard for me to tell where those funds are at right now. I know that when we raised, we were one of the larger funds, but since then we've seen...
When you were with Polychain?
No. When we raised Placeholder, we were one of the larger funds. But now, as the space has grown, there's been larger funds. For example, Andreessen's $300 million fund is now
you mean
A16C. Correct. And so we're about I think medium size for crypto. Within the broader kind of investment community, it is a small fund, or at least given our investors, which are largely institutional LPs. We are considered a small fund, and it is our first fund. But it works well for us because it allows us to stay pretty nimble. So
can you tell me a little bit more about, can you just talk a little bit about the difference between why you decided to go become a VC as opposed to hedge fund structure? What is the difference, and why did you pick one or the other?
So we had a conversation about how we wanted to work and the kind of work that we wanted to do. And the thing with a hedge fund structure is that a hedge fund manager's job is to be trading, is to be in the market buying and selling with a relatively high frequency, trying to profit off of fluctuations in the market. We were analysts. We were just geeking out over these technologies and wanting to work with the teams and work to solve these incredibly important problems. And we wanted to spend our time helping networks succeed and helping promote networks And so the venture capital structure, it gives us a 10-year platform that allows us to settle back and not have to worry about what's going on in the market in the short term and really focus on doing deep work with the teams.
More of a hands-on approach.
Correct. And that is venture style. If you think of a venture capitalist invests in a company, joins the board, and helps the company succeed. That's the kind of work that we want to do for our portfolio teams.
And Chris, you had a book.
I had a book?
You have a book.
He has a book.
Yeah, I have a book.
And the book is?
Crypto Assets, The Innovative Investor's Guide to Bitcoin and Beyond.
That did pretty well too, huh?
It did well.
Now, I was looking at your website. It says that you collaborate with firms like Union Square Ventures, A16Z, and Blue Yard. How do you collaborate with them?
Well, 2 of the 3 are LPs of ours. And
Okay.
then we, as a venture firm that tends to lead deals, we will syndicate groups of investors. And the investors that we're most likely to syndicate a deal with would be USV, Andreessen, and Blue Yard.
Okay, cool. Now, you mentioned that Decred is your first investment thesis?
It's our biggest investment, and I think it was the second asset that we purchased.
That's right. We've made about 9 investments so far. Decred is the only one we've announced publicly. We're going to announce more. But Decred, we have a long history with Decred. Prior to Placeholder, I remember another conversation we had walking down 12th Ave in New York City where Chris was telling me about Decred. And this was when Chris was working at ARC, I was working at USV, and he convinced me. And I think we became stakeholders right then and there, or that evening. And so as the time went by, when we closed the fund, that was one of the first things we had our eyes on.
It was actually Willy Woo who converted me, and he was like, "Chris, you gotta look at Decred," and had a small position.
Who's Willy Woo?
Willy Woo's an OG crypto analyst. He's not anonymous, but he stays in the shadows a little more, say, than we do. We go on kite surfing retreats with Willy Woo, but I'm a big fan of him. He's a straight shooter, but when actually I made the big leap with Decred personally was right before the SEC announced that they were going to reject the Winklevoss Bitcoin ETF.
Right.
This was, I think, March of 2017, and I was pretty sure that the Bitcoin ETF was not going to go through, and so divested of a fair amount of my Bitcoin into Decred. And I think Decred was like $2 or $3 at the time. And so that did well, and of course when something does well, you pay more attention to it, and so started falling down the rabbit hole.
How much at the time?
It was $2 or $3, I think.
And what is it at now?
It's at 40. But it was, that was sort of the genesis, and then really with making Decred one of our core positions in the fund, we've gotten to know Marco and the whole team much better, and are really getting involved. Right now we're working on getting the team an opinion letter on the fact that DCR is not a security. We're working on educating different custodians, different exchanges, particularly exchanges with fiat integrations, and really just doing everything we can to make Decred more of a success.
So you have an opinion later that DCR is not a security?
Working on getting one.
Now, I wouldn't think that DCR would be a security. Why would that be?
Well,
it's one of the most controversial topics in the entire space, because there's now this, as the SEC makes its way more and more into the space, there's kind of conflicting opinions on what constitutes a security and what isn't. We are of the opinion that Decred is not, but it is important for us to have documentation from a law firm doing the analysis, because it's useful for example, the work that Chris described of getting the asset listed on exchanges and custodians. Some of them require these kinds of documents.
That's really interesting, because when I think about the coins that are non-compliant securities, I tend to think of ICO tokens. Not,
exactly. But there's, for example, if you talk with different people, sometimes they will mischaracterize Decred's airdrop as having been some kind of ICO. And so it's important to say no. And
it was an airdrop. Did they also they had a pre-mine as well, or?
Well, so sometimes the airdrop is characterized as a pre-mine, which pre-mine kind of goes back in time within Bitcoin, and then pre-mine really more applies to things like what Bitcoin did.
Does everybody know what a pre-mine is? It's
a pre-mine is basically when there's a creation. It can either be the network is mined quietly over time, such that a significant amount of the supply is in existence before people really become aware of it. So that's what Bitcoin did, and that's why Bitcoin got forked, and Monero was born. But a pre-mine can also be, where there's a creation of coins before mining starts.
Right.
And so that's where, okay, there was a creation of coins for an airdrop, and then into Decred's network Treasury, a marginal one, 4% and 4%. And then mining started. And so that's where you'll have some maximalists say, oh, there was a pre-mine here. But it's, I think, one of the great things with Decred is how experimental it's been with its monetary policy and pushing the edge there. And so the security letter, or the opinion letter on the fact that Decred's not a security, is really going through the launch process and how the token has gone into the hands of different stakeholders and how it has true utility. And if you start going through all those things, it has none of the characteristics of being a security. The only thing that gives people a little indigestion is that through one light, you could see Decred as being a yield-bearing asset when you stake it, but it is not passive. It's not passively yield-bearing. It's active participation that allows you to earn income. And so we make the argument that as a staker, you are very similar to a miner. You're providing a service. You're earning income for that service. It's not a yield-bearing security.
And then for people who don't know, a staker is somebody who...
A staker is the people that stake their Decred to buy tickets to then participate in the consensus process and the on-chain voting process.
So they're coin holders that have an opportunity to vote within the system. So it's not just the miners, right? Well, that's really interesting. The securities things, I didn't know that would be something that you'd think of for something like Decred so that's really interesting.
We spend a lot of time with lawyers, so it's something we're naturally suited to be thinking about.
Yeah, no, that's pretty cool. So, and then getting back to, Decred is doing a lot of stuff that's really interesting around governance. Why do you think governance is so important to look at? I mean, when you look at an investment, why is governance one of the things you might consider?
I want to give Joel the stage here because he didn't get a chance this morning.
In
the governance panel, he didn't get a chance.
That was a great panel.
No, it wasn't.
The way we think about it is in these systems, there's two kind of main areas of practice, which happen to be the areas of practice that we focus on, and or two pillars of infrastructure.
I don't want to assume that everybody
knows.
So
governance for us is anything that represents the power to change the rules within a crypto network or a crypto system, and this is within the context of crypto. And that can take many shapes and forms. It can be a model where it's proof of work based, and the miners have the power to change the rules of the system. It can be something like Decred, where it's more evenly split between the miners and the stakers. It can be systems like 0x, for instance, which is proposing just a token-based voting system. But all of those are different implementations of the same concept, which is just the power to change the rules of the system. Cryptoeconomics are more like the rules of the system. And so the cryptoeconomics of a network dictate who gets paid what and for what kind of work and what kind of labor. Governance is important because there's this kind of continuous debate or struggle within any system for how value is being allocated. And the decision of how value is allocated happens through a governance process of some kind. Now, for us, when we think about the long-term deployment of these crypto networks or these crypto systems, we understand that systems need to change and evolve and adapt over time in order to reach scale. And this is because the more people you have participating in a network, the more differing opinions and the higher need of consensus. Now, there's all kinds of mechanisms that we've seen being used, like, for example, forking is one form or one one governance mechanism, which is very effective when you have a highly contentious debate between a community where sometimes the only solution is to defect. It's to split the network and have the people who strongly disagree go somewhere different than the people that have a different opinion. However, there's a range of decisions and topics and ideas and points that are not worth a fork, but are worth a vote. And that's where we think about designing more intricate voting systems or more intricate governance systems, like what the type of work that Decred is trying to do, because there's just many of those things where it's not worth splitting a network. And the thing is, as networks grow larger and larger and larger, the cost of forking grows larger and larger and larger because it impacts a lot more people and it creates more discrepancies. And so we think that as these networks scale, the need for governance systems that allow the network to adopt to new market pressures or market shocks becomes more important.
Right. So you look at governance in terms of how viable is this system going to be over the long term, right?
And I would add too, the word governance is certainly a contentious one, and I think it's because it's broad and it's not well defined in most situations. And Joel just did a good job of defining it. But I think you'll hear people say, we don't need governance, and I think that's a fallacy. Every system has governance of some sort, and Bitcoin has chosen its governance system. Is it optimal? In my opinion, it's not. I would prefer something that's more explicit, that's more transparent, where I understand more clearly how the rules of the game are being changed.
Right.
But that's for me, right? And so I have chosen Decred more as my governance system, and it's totally up to someone else whether they would prefer Bitcoin's governance system. But it's all a choice.
And from what I understand, I mean, while Bitcoin was still arguing about things like SegWit and Lightning Network,
I think over time,
Decred had already implemented those,
I think
right?
Decred is already proving that it can iterate at a faster pace than Bitcoin.
Right, and that's kind of what you're saying about governance is you can make these decisions, you can upgrade, you can stay current without splitting the network. So there's a more democratic decision making.
Definitely, it streamlines decision making. Now this isn't, I think often things get pitted against one another. I think that Bitcoin has its place in the world, and I actually think for a reserve asset of crypto that's kind of indifferent to everything else, maybe this governance by defection where it's a pretty small group is what that kind of asset needs. And so, is Decred going to become the reserve asset of crypto the way Bitcoin has become or currently is the reserve asset? That I don't know, but I don't think that it has to become that in order for Decred to become a massive success. And so that's where I think for me, long term, what would maybe be the most exciting thing is to see all different kinds of organizations timestamping their proposals, iterating on their proposals, making their governance decisions with Decred as the underlying platform. Because that, I think that affects positive social change in a way and potentially on a scale which we haven't seen yet within crypto.
Yeah, and just pivoting a bit from that talk about governance too, another topic that I find is really interesting is this whole thing about Treasury systems and DAOs and how to make decisions about how money is spent or even beyond that, how do you, because there have been, I think Bitcoin, and you guys probably know more than I do, at one point the Bitcoin Foundation was about to run out of money, right?
Well, and Ethereum's foundation ran into this as well.
Ethereum ran out of money too.
Got close.
It got very close. So there has to be a way to make sure that these protocols or networks can fund themselves over the long term. Where's the money? Because if it's ICO money, you can run out of that. And so maybe, can you talk about that a little bit about what a Treasury system is, how it differs from an ICO?
Sure.
And a foundation. I mean, what's the difference and what are the benefits, one or the other?
Sure. And this is clearly an area of vast experimentation within crypto. There are systems like Bitcoin or Monero where there is no treasury, right? And in lots of those scenarios, the core devs are not as clearly compensated as I think they should be.
Well, how do they get money then?
Well, they end up getting money through different mechanisms, right? So there's Blockstream.
For Bitcoin, right?
Well, Blockstream is a corporation that raised a lot of venture money without a clear business model and has been iterating on what that business model should be, but in the interim has provided food and housing for the core developers of Bitcoin, which are very important developers, right?
Yeah.
And so that was sort of
That's sort of like a VC funded where it's become kind of corporate.
that was the first rendition of its kind of, you're not explicitly accounted for within this network's monetary policy. You take something like Decred, where the monetary policy compensates the miners, 60% to the miners as opposed to 100% to the miners, which is how Bitcoin works. 30% to the stakeholders, and then 10% to the Treasury. And I really see the Treasury...
Well, back up just a little bit. Where does the money come from in Decred?
Right. So the money is minted over time, and that's one of the magical things we can...
It's like 10% off the mining reward, right?
Yes. So there's a Coinbase reward, just as Bitcoin has a Coinbase reward, but that Coinbase reward in Decred is divvied up. And so money is minted over time through a mathematically metered monetary policy. And that's one of the magical things we can do with magic internet money, right? We can mint it over time, and so long as there's positive expected value about how this network will work, then the market will assign a price to that asset. And so what I see with Decred expanded the conception of what a network supply side should be. The supply side really being the actors who provision the service of the network. And they said, we want to take care of the miners, we want to take care of the decision makers, we want to take care of the developers. And so they accounted for all of those with their monetary policy. Then there are ICOs, right? And ICOs I kind of see as a big middleman, where you can have two different kinds of capital. You can have investment capital or you can have productive capital. And with something like Decred, you mint the money straight into productive capital in the form of hashing power from the miners, decision-making power from the stakers, or contributing code from the developers. With an ICO, you really fund the money into investment capital and then rely on a relatively concentrated team to make the decisions about how that capital will be spent on productive capital. And so you're kind of a step removed, as opposed to directing or injecting cash straight into the economy. It just kind of sits on balance sheets.
Even ICO money can run, I mean, it's not infinite. You get only so much, right?
It's not. Yeah.
And there's no way to know how that money is going to be spent, right? So if you get have an ICO where you get $232 million, you don't know that the people making the decisions, are they buying,
That was a good reference to Tezos. Was that Tezos?
No.
Very specific number.
But how do you keep that in check? I mean, even if you have huge sums of money, you never know how long that's going to last for. Whereas if you have like a system like Decred that puts it into a treasury, you have a consistent amount of money over time because you're taking it out of the...
There's an important subtlety in how Decred works that we think it's really fantastic, which is there's a fixed percentage amount of the newly minted Decred that is allocated to the developer pool.
Right.
But the value of that developer pool is determined by the market for Decred. And what that means is that as Decred grows and the value of Decred increases because more people are coming to the network and participating, then the value of that developer pool increases as well because it's denominated in Decred. And so, for example, if you raise a fixed amount of dollar money for a crypto network, say $50 million, and you're now you have all this capital that you need to allocate and manage, and that's kind of fixed. It's just going to dwindle over time if you think about it. You run out of it. But if Decred is successful, the size of that pool actually grows over time, because it means that if the price of Decred is higher next year than it is today, then each 10% reward that gets allocated to the pool is worth more.
Does everybody understand the Treasury system? Because it's really kind of interesting. But and not only that, but they're trying to move towards there are other systems that use treasuries, right? I mean, it's not just Decred. There's Dash. There's what makes one system different or better than another?
Well, they're architected in different ways, and I think some of it comes down, or will come down as well, to the ethos of the community. I'm not super familiar with all of the things that Dash allocates resources to, but it feels like it's very marketing heavy to me. Whereas with Decred, my intuition is that while Decred needs more education, my intuition is that there will be more meaningful things that are built with this beyond just proselytizing.
So, and before we go to Q&A, I have one more question for you guys. Is like, how are you actively involved with Decred? You know? So
I outlined a few of the things that we currently have ongoing in terms of interfacing with the lawyers, the exchanges, the custodians, pulling together a group of all the large funds and holders of Decred that we know, so that we can jointly go to these service providers as well and educate them on the merits of Decred. The other thing we're in the midst of working on is setting up a staking pool. And part of I think you should detail the realization around why a institutional investor staking pool
and then I have another
might be
question
helpful.
for you too. I mean, if you have access to all these DCR, right? Does that then mean you get to make decisions about?
We get to vote.
You get to vote.
We don't get to make decisions, but we get to vote.
Don't you stake and everything? Are you?
That's what we're working on, and
right.
so.
But won't you have kind of a pretty big influence on the network and the future direction of it?
Potentially, yes.
Yeah.
And it feeds back into the work that we've been doing on figuring out what is the right way to stake, because we want to strike a balance between our position as financial partners to the network. And what I mean by that is one way in which we participate actively is by buying Decred and buying consistently over time, as we have been doing over the past year.
So you're going to keep buying more Decred?
Correct. And so as every time that we go and buy another block of Decred, we're directly capitalizing the network, because we're helping sustain the price of Decred or helping add capital to the system.
Is there no concern you're going to be like a whale? And
potentially, but
we are a whale.
We are a bit of a whale. But we keep that in mind, because we don't want to become so much of a whale that we start compromising on the values of the network. And this feeds back into the work that we've been doing on the staking pool. There's a couple of things that we want to accomplish. One, we had a realization around the importance of setting up a staking pool for funds. And this is very kind of mechanical, but the reason is that as fund managers, we have certain fiduciary responsibilities in terms of who our service providers are and who we interact with. And we realized that we can't just stake with a random staking pool, legitimate as it may be, if we don't have a contractual relationship and can KYC and AML the provider, and that makes it difficult for funds to stake. But the other thing that came to the fold as we were thinking through these issues is a transparency concern, where if we set up a staking pool that is for institutional investors, and this is transparent to everyone in the network, everyone can identify that this pool is this group of funds, then the entire market or the entire network can tell how we're acting and can tell how the institutional investor community within Decred is reacting to certain proposals or voting on certain proposals. So we don't think there's anything wrong with being a large holder of Decred, as long as we participate on the same basis as everyone else.
And there's some transparency is what you're saying.
Correct.
Okay.
And the other thing we do for the network is we wear these T-shirts all the time.
And they do. Does anybody have any questions for these guys?
I can ask one.
Hang on, we'll get you a mic.
Thank you.
Do that one.
I'm new to Decred. I've been impressed by it, so I'm learning. You said I can see the upside of having a Treasury system that regularly has a draw. So there's a promise of continued investment back into the code base. But I don't see how that's linked to when you need to invest in a project. So you said the market, it may go up or down. If the market really values it, then there's more opportunity to invest in it. For me, that's not linked to when you might invest in a project, right? It might be greater opportunity to invest in now, and in the future, maybe you don't need as much innovation, or maybe it'll scale in some other way. And what I heard implicit in your answer was, if the market value goes up, there's more resources around, we'll invest more. If the market value goes down, we'll have less to invest.
I'm sure I heard that.
Yeah.
Well, so I think there's the, when you're referencing investment, you're referencing investment from the network treasury into projects. Yeah. So the way I think about that, long term, the value of DCR, if the network is doing well and providing more utility to the world, should go up. And if the value of DCR goes up, then the treasury will swell in fiat terms, right? And so we'll be able, basically that means DCR's purchasing power is going to go up, and we'll be able to purchase more resources for itself. And I think that's exactly what should happen over time. I mean, we're going to have these kind of boom-bust cycles, and one bad thing is if the treasury shrinks because DCR is falling, then that could actually, it's not a counter-cyclical, right? It's actually a positive reinforcer of, well, maybe we shouldn't spend in this time because DCR is worth less. I think you could interpret it that way. I think you could also interpret it of there might be more proposals to do things in that time, because if I want $100,000 and Decred's at 40, I'm going to get a lot more DCR for that than if Decred's at 100, right? So you could see it from the contractor perspective of there's more incentive. I know I will get more DCR when DCR itself is at a lower price. So that could be a counter-cyclical if you're looking to accumulate units of DCR. The last thing I would say, and this is from conversations with our third partner, Brad, who, Brad and Fred, while at USV, led deals on things like Twitter and Twilio and MongoDB and Tumblr. And I remember talking with Brad about Tumblr and their experience, because they were one of the first investors. Tumblr took a relatively small amount of capital to build the software. But then where it needed a lot of capital was actually to scale the machines. And so that's where they had to go and start raising more and more money. And what's interesting with something like Decred is as the monetary base grows, you can be raising more and more money in dollar terms if DCR is going up, while you are becoming less and less dilutive to the overall unit amount. Because if I have 8 million Decred outstanding right now and I mint 25, that's a higher inflation rate than if I have 10 million Decred and mint 25. And so there's this interesting sort of the nuance in that as the network scales in size, it can raise more money even though it is diluting its holders less and less and less.
Cool.
Can I just one follow-up?
Well, let's give somebody else. Let's give somebody else.
Life cycle is that.
It's all right.
All right. So the other idea. So I can imagine, if we imagine growth, right? So that's the positive scenario. Everything's going to grow, therefore it'll all grow. Implicit in my question was also, isn't there a life cycle to technology? Isn't there a point at which you want to divest? Isn't there a point at which this technology will have reached its cash cow position, and therefore it's time not to keep investing in software that isn't really where it should be?
That is kind of an interesting question.
So are you thinking about a point at which the size of the Treasury far exceeds the amount of work that you're able to fund or that you should fund?
Allow flexibility.
Right. Well, that's where it goes back to the beginning of the conversation about what are your governance processes, and then how do you evolve the network at that point. And so, for example, I'll just invent random numbers. Let's say that we get to a point where Decred is highly scaled, highly available, very global, and there's $1 billion sitting in the developer pool, and there's nothing to do. How do you decide what to do with those assets? Well, this is where Politeia comes into mind, and so the network could decide to vote to distribute that to all holders, for example, or the network could decide to burn it because you don't need it. Or require a startup, or set up there's any number of things that you can do, but it gets us back to as these networks scale, the needs that come up change, and the governance process becomes the important factor.
Next question.
I guess I have a couple, but I was curious as to your comments related to your getting an opinion of counsel regarding your statuses, whether Decred was a security or not. I'll put that one aside, but I think there were rumors earlier this year that Decred was going to be used as the basis for the Petrocoin in Venezuela. That has subsequently been sanctioned by OFAC, and I was just curious, even if that wasn't what was ultimately used, if you've given any thought to having the network, used, whether it's a fork or whatever, but that what the implications could be of having a sanctioned, do not fly type coin or something piggybacking on the network.
Do you understand that question? Because I'm not sure I did.
I kind of got it, and I believe you're a lawyer, so I would like to hear your opinion on whether Decred is a security or not. In terms of
repeat the question, because I didn't understand it.
I think the question is around, should the stakeholder base be able to have a say in blacklisting projects that build on top of Decred, or you heard something different?
Something different.
Well, I interpreted your question as basically what are some of the kind of unintended consequences of having such an open technology that anyone can kind of build upon it, and what would happen if something that someone built subsequently gets sanctioned, to pick an example, and how does that affect the value of the project? And it's, I don't know what the Petrocoin was built on, but for example, let's just assume it was built on Ethereum. You wouldn't want a sanction of an ERC-20 to then affect the underlying the integrity of the underlying blockchain. But I think there's a broader question, which is where Chris was going, which I think ends up being actually the answer of do we need to create systems that allow a community as a whole to dictate what can get built and what can't? And I personally think the answer is yes. And ultimately, if you take forks as the ultimate mechanism by which if someone really vehemently disagrees with a decision, they can just leave, and you kind of have that. But going back to the range of things that are worth a vote but not a fork, I think this falls somewhere in that category. And I think we've seen examples kind of similar to that in terms of just within Ethereum itself. Decisions about whether to bail out something like the DAO is an example of what happens when something goes wrong on top of the protocol, on top of the network. How does the underlying system react to it? And in the case of something like the Petrocoin, I think, let's just pick that as an example. Let's imagine that it were built on top of something like Decred, and then let's imagine that the Decred community as a whole decided, well, we don't really want that, and submitted a vote, or put it to a vote whether we should kick this project out or not. I think that's kind of great, but it comes back to having the right processes for the community to negotiate these decisions.
Any other questions? I know y'all are heavy in Decred. Can you just give a little glimpse? I mean, you don't have to give me the secret sauce or anything, but what other holdings does your fund have? What percentage do y'all have, or just, I mean, how heavy are y'all in Decred versus other coins?
So Decred is our largest investment by about twice the next largest. It's about 5% of the fund now. And we're just consistently increasing our position. We have investments in other assets. For example, we're investors in 0x. We're investors in Aragon. We're investors in Bitcoin. We have some Bitcoin in the fund. We're investors in some pre-release networks that haven't launched yet, like OS Coin, which is a coin for the open source developer community. We're also investors in a system called Cash, which is a decentralized content delivery network, and system, and Filecoin as well. We participated in that sale. We're also investors in Maker, which is a decentralized stablecoin.
Thank you for asking that question.
One of the advantages of a venture fund is we can talk about our portfolio.
have a question. Filecoin is SAFT, right?
Yes.
So how do you...
Oh, and Zeppelin.
Zeppelin's a SAFT. Zeppelin, for those of you who are familiar with the Ethereum developer community, we're investors in Zeppelin as well.
How does that work? I've heard there's some issues with SAFT or...
Yeah, I mean, SAFTs are actually, Joel's quasi-responsible for inventing the SAFT. In collaboration with Juan Bennett, Benet. Is it Benet? Yeah. But really, it was coin shares.
Context on the SAFT. The SAFT came about because when I was at USV, we had invested in Protocol Labs, the company, the equity. And Juan and I were trying to solve the problem of how do we raise money for Filecoin by selling Filecoin to investors or stakeholders or people who are going to provide storage to the network without selling, without doing an ICO because the network wasn't ready or the token wasn't going to launch. And so Y Combinator has had this structure called the SAFE for a while, Simple Agreement for Future Equity, and we just went, well, Simple Agreement for Future Tokens and called it a day. It's a little bit of a mistake because, well, I think that...
What's a mistake, SAFT or...?
I think that people misuse it in the sense that SAFTs were really designed or conceptualized to be used right before network launch or shortly before network launch when you already know how the network's going to work, what the economics are, because you're pre-selling a specific amount of tokens. People took that instrument and used it as a way to raise money without having to sell equity at a time when everything was heated and people were just buying whatever was being presented to them because they were chasing returns. And as a result, a lot of teams sold SAFTs for immature networks with underdefined economics and systems, and that's created a whole bunch of issues for a whole bunch of people. So we're not big fans of SAFTs. We prefer to invest in equity at the early stage of pre-release and construct terms that give investors in the equity a right to any tokens that are issued. And what that does for the teams is that it allows them, it affords them the flexibility to iterate on the economic model because what they sold was not a specific amount of tokens, but rather what they sold is a share of their share, essentially. Mm-hmm. And so if we buy 20% of a company that then issues a token and keeps 20% of the token for themselves, then we effectively bought 4% of that network because we bought 20% of that 20%. Is that right? The number's right? Okay. He's the math guy. Yeah, so SAFTs, we've done SAFTs. We've invested in 2 SAFTs, but we're not fans of the instrument.
You won't invest in any more SAFTs?
No, I don't think so.
Too many problems?
Yeah.
The only other thing I'd add is by number, we're about half pre-network launch assets where we really get involved with the teams and helping them actually build something that will work and try and minimize the percent, even though it's somewhat against our own self-interest, but in order to create a hugely successful network, I think you have to be careful of over-prioritizing the financiers and the people who hold capital, and you need to leave the majority of the token to be earned by the supply side because that's actually what builds out the utility of the network. And so, that's where we're a little bit we do a bit of a dance of how do we help capitalize a team early on when they're building something like a decentralized GitHub and we know it's going to take them 18 months and they don't have the capital reserves to do it on their own. How do we come in, give them the capital reserves to do it without then actually killing the network because you've overly prioritized capital and so no one's going to participate or no one can get can reap the benefits of participating. So that's a balance, but we're about half pre-network launch and half public assets.
Yeah. I just had a question. I believe that Vitalik Buterin has come out against on-chain governance, and I believe his argument is something along the lines of, if it's on-chain governance, it could lead to a situation where you scratch my back and I scratch yours. You vote for my thing and I vote for yours. I believe that's correct, but can you just give your thoughts on what he had to say against
like real-world governance, right?
I'm sorry.
Like real-world governance.
I guess so.
Well, I have a lot of respect for Vitalik, but I don't think that Vitalik's God who has all of the answers to all things. I think that there's a lot of good research. There's a gentleman by the name of Phil Dyan from Cornell who has done some great writing on some of the potential deficiencies of on-chain governance. And I think we have to be aware of those deficiencies. The way I see it, these ledgers are fantastic at transferring and securing valuable assets, and I think of my vote as one of the most valuable assets there is in the world. Not mine in particular, but a human's vote and a human's ability to make decisions, and so not trying to use this technology to improve the transferring and securing of our votes and our decision-making processes would be a mistake. So it's more, let's experiment with it. This is how humans innovate. We get it wrong 99 times before we get it right once, but it's getting it right once that moves society forward. And so I think that the vast majority of on-chain governance experiments will probably fail, but the ones that do well will really pave the way for future ways that we architect our governance systems.
These are some good questions. Do we have another one?
Who was the name of the guy at Cornell?
Phil Dyan. So D-A-I-A-N. He's got a great post on dark DAOs and vote buying, which raises a lot of very credible concerns around on-chain governance.
And I like that word, dark DAOs.
If the two of you guys and your third partner, Brad, leave your office and walk across the street for a sandwich and get run over by a runaway bus, how do your investors get the Decred? And I don't mean to compromise the integrity of your operation, but I mean if you've been in Decred for a while and you're just using their own wallet like Decredition and it's got a key, I'm just wondering, in an organization where you have partners or a partnership owns the crypto, do you have any advice or guidance for how to secure those assets but allow survivors to obtain them?
Do you take separate plane flights all the time? Or do you ever,
We don't, but we don't eat sandwiches at the same place. That's the...
Don't cross the street at the same time.
Keyman risk is basically the technical term in the fund management in many industries. That is one of the risks that is put in our investment terms when we onboarded investors into our fund. We had a long list of disclosures of everything that could go wrong, and we worked on that document and we realized everything that could go wrong, and this is one of them. And obviously, to answer your question more directly, what you want to do is put your backups in a place where the fund as an entity has an authority to go get the backup seat for your assets. And you work with your estate lawyers and you work with your custodians to do that. We're working now with third-party custodians, as Chris mentioned, to try and get Decred support into places like Coinbase Custody and BitGo and so on, and all of those accounts are in the name of the fund. So should we become incapacitated, then the advisory board essentially has authority to go and procure the assets of the fund.
That was a good question, too.
Any other questions?
Thank you guys for coming and speaking to us. I'd like to ask you guys your opinion, a bit of a thought experiment. So I think most of us here are of the opinion that the vast majority of all these projects and tokens will die off eventually. So I'd like to pose the question, let's say we're 10 years into the future and Decred, for whatever reason, just died off, it didn't make it. What do you think went wrong, or why did the project collapse?
That's a great question, and we actually call that exercise a pre-mortem.
Question.
And a pre-mortem is, let's try and do exactly that exercise. And we actually did it for crypto as a whole. I don't think we've done it for specific networks.
So I know what comes to mind for me. I think that Decred has one of the most elegantly constructed supply-side mechanisms to keep the whole supply side churning over time, and the monetary policy is going to allow that to go on for a while, and because we're only about a third of the supply minted. But I think what we all have to do, and this is just a matter of staging, and I don't think it's been the right time, but we're getting to the point where we're going to be at the right time, and that's figuring out what does the demand side look like. I can paint a very strong picture to investors around why Decred is great if integrated in a basket of other crypto assets. And so the investor demand side is something that I feel comfortable describing to people. But I think on the user demand side, and this is where I really focus on the potential to extend Politeia long term, that is something that I think we have to get going. But it's just finding ways, or what will be the things that people go to Decred specifically to use it. And if we don't get that demand side robust over the long term, then as the because you can price Decred purely from a supply side perspective, the returns that you get from owning Decred or mining or all of that. But as we get later into the monetary policy schedule, if we haven't developed a robust demand side and the supply side starts to sort of slough off, then I think we could hit issues. But I think we have at least a decade to figure that out.
So they have to use it as like an actual payment system, and it has to be an actual economy.
Yeah, and I'm a little skeptical of using fixed supply currencies as a run-of-the-mill means of exchange. The psychological burden of spending what is likely to be a deflationary asset is too great. And so in order to spend it, you have to be getting a meaningful service. And I think that recording my proposals or changes to my proposals or recording votes, those are super high value add processes that could modernize a lot of our governments of the world. And if not the governments, just sort of local or municipalities. That is something that I think people will be willing to go buy a little Decred for, spend it. The whole user experience, the whole user interface, all of this stuff has to improve at least an order of magnitude, if not 2 orders of magnitude, to become a reality. But I see it there. And us as investors, you only make money as an investor investing before there's certainty. And so we're in a period of uncertainty. But we think probabilistically, Decred has a great chance of succeeding at building that demand side.
Good.
Any other questions?
We still have time for a couple more questions
Well, I'll keep
before
going
happy hour.
I get the...
It's Capital Factory happy hour. Go ahead.
I had a question for Chris. You had a tweet in the past few days talking about how centralized services will accrue value on top of the decentralized services. And I don't disagree with it, but I found it kind of depressing, So I was just curious, are you going to develop it into like a full thesis or a blog entry on the Placeholder website?
Well, it was just an iteration of FAT protocols. But the line of thinking was that maybe it's, at least in the short to medium term, centralized applications on top of decentralized protocols. That's the winning combination. And that's because the application layer needs to be hyper responsive, have a fantastic user experience in order to get people to convert to actually use it on a regular basis. But the underlying protocols providing these services, be it money over IP, or voting over IP, or storage over IP, over time, and already, I mean, we saw the SIA presentation, and they're provisioning storage at an order of magnitude less cost than AWS. I think over time, these protocols should run more efficiently. The infrastructure protocols that benefit from decentralization should run more efficiently than their centralized counterparts. And so I see companies like Coinbase or Circle or some of the big centralized applications actually being able to outcompete the JP Morgans or outcompete the Barclays because they are running on infrastructure that is fundamentally lower cost and on demand, and they're not locked into these 9-figure contracts with archaic service providers. And so I think that the centralized applications that succeed at doing that will also drive adoption of the underlying decentralized protocols. But do you have more you would want to say about this? I mean, Joel put out the FAT protocols thesis in 2016, which has been misinterpreted a lot. But this kind of goes back to the idea that you don't have to decentralize all the things. And in fact, we shouldn't. But what we should decentralize are the things that benefit from decentralization. And then, longer term, will dApps actually gain traction? I hope so. But I don't see it in the short to medium term.
Any other questions? Yeah, I'm going to go here first.
I will admit a little bit of confusion in the messaging between the currency aspect of it and people choosing to use Decred as a currency in use, which will go up in value, versus the network effect. And I appreciate the elegance of what you're explaining from the network perspective. I guess the question I've got for you is, what kind of impact do you think stablecoins are going to have in the world that you're existing in? Do you see a stablecoin coming into the Decred world?
They're on Binance, right?
They're on Binance. We've had an interesting journey with stablecoins because without getting too much into some of the issues, basically to answer your question more directly, I think that we will have a large number of stablecoins, very different kinds of stablecoins that derive their stability from different sources. So you have systems like Maker, which derive their stability from collateral of other crypto assets. You have stablecoins like USDC, which Coinbase and Circle just released this last week, which is backed by actual dollars sitting in a bank account and audited. And I think that you will have stablecoins being released by governments themselves that realize that they need to participate in this ecosystem or benefit from the advantages of creating their own cryptocurrency, however centralized. Ultimately, I think that stablecoins will fulfill the means of exchange, the medium of exchange functionality of crypto. I don't think, for the reasons that Chris mentioned, with some, systems that have fixed monetary supplies or systems that are deflationary, it's not a very good currency. So I think that stablecoins will actually alleviate some of the pressure from projects like Bitcoin and Decred to be this currency that people use to buy their coffee. So I very much welcome that development, but will open up a whole wave of innovation in terms of, okay, what can we do with crypto assets with other more exotic kinds of networks, and we can create more governance systems or other kinds of tokens that serve different purposes. Now, there is something that scares me a little bit about stable coins, and it's basically a little bit of pattern recognition of separating the currency from the capital, which is something that we did in modern capitalism as we tried to scale it. I think that the single responsible or the single cost for income and wealth inequality, I think, is when we started to create this separation between capital assets and currency assets, and the problem being that capital assets accumulate value over time, whereas currency assets lose value over time as they're being used and as they're being inflated. And the problem is that most people live their lives in currency and very few people live their lives in capital. And increasingly fewer people live their lives in capital, and so that's why we see this basically wealth skewed towards those who hold the capital versus those who hold the currency. And I would hate to see us create this technology or use this technology to precisely address those issues of income and wealth inequality, and then fall back into the same system and creating stable coins that most people use, but then they don't get to participate in the value accruing properties of other monetary systems. So I think there's a balance there that we need to find, but I do think that it will serve as an onboarding for a lot of people to come into the space.
It's 5:30. We're out of time. So
One more question, or are you done?
Well, it is 5:30, so we are out of time, so it's up to you.
All right, one more.
So Chris, you said there was a tension in a pre-public launched company between taking too strong a financial position and lowering the incentives for participation in the network. Have you considered, in addition to taking equity positions or purchasing positions, providing a line of credit or using debt financing as an alternative, which is a way to provide liquidity without potentially disrupting a network?
Well, we just did a debt financing or a convertible note.
So debt financing to like a developer team to because the thing is, a convertible note is paid back with equity, so it's really an equity financing. You know, So there's a project called Dharma, which is a decentralized credit network, whose go-to-market strategy was basically to create debt financings for teams. The reason venture capital exists is because early stage technology ventures are way too risky for a debt financing. And when you take money from a venture investor, it's risk capital. And if the venture fails, then the VC loses their money and there's really no recourse. The reason a highly risky, highly speculative technology venture can't go to a bank and get a good line of credit is precisely because it is highly risky, and it would put too much pressure on the company to have a debt line. And I think it would financially be pretty bad for a team to finance the development of a crypto network with loans and then have that fail in some way, and then the team is left with this huge liability, and it can screw them in all sorts of terrible ways. So I think risk capital is the right capital to fund this ecosystem. It's part of the reason why we created a venture firm, is we recognize that behind all these multi-$100-million network values and whatever craziness was going on in the market, these were still early stage technology companies with all the dramas and fires that happen to startups, except that now their assets are being marked to market by the minute. And the volatility that we see in this space is, I think, reflective of the underlying risk of the companies and the ventures.
Okay, everybody, I guess that's it. Thank you both so much.
Thank you.
Great question.